HP's shares were down on the latest quarterly reporting, and so the question is now the time to buy? And so in this video, I'm going to provide my perspective, but also I want you guys to provide your perspective in the comments down below, and I'll respond to every single one of them. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And so starting off right away, you can see that there is just continued weakness in the PC space, which is what management told us, and it's what has caused the share price to decline. Interestingly enough, I think the valuation of the company is getting pretty cheap, or closer to that cheap point, I would say. You know, they have a trailing 12-month PE ratio of 11 times earnings, which is very, very low in my perspective. And so let's dive a little bit into their press release. So you can see that they did say that net revenue was down almost 10%, 7.5% on a constant currency basis. And, you know, they do expect, or they do expect to get another quarter of sequential growth in Q4. Remember, they just reported Q3. They did mention that the external environment has not improved as quickly as they anticipated, and they are moderating their expectations. Now, luckily enough, you guys know that I tend to value companies in a very conservative way, and I had already moderated my expectation way back in late 2022, and so I actually had to take up my EPS estimate for the full year of 2023 from $2.50 per share to around $3 per share, which is what they're guiding us to. And so just an FYI on what's happening specifically in the business, you can see the personal systems revenue is down 11% year over year and 8% on a constant currency basis. And so this is that challenge in the PC market. And then of course, just a little bit better, printing was down 7% year over year, 5% on a constant currency basis. So we're really hoping that the consumer PC market picks back up. Part of it is just, you know, there was a lot of inventory at the retailers space, and, you know, the other part of it is that, you know, obviously the higher levels of inventory at the retailer level is because of the ultimate consumer slowdown, and so we're hoping that that turns. And so they provide a very good presentation deck, and so just as a reminder guys, you can see that the 47 personal systems commercial plus the personal systems consumer, so 70% of the business is PC, the remaining 30% is printing. So just as an FYI. And then of course, you know, you can see that the big weakness is in the Americas and the Asia Pacific and Japan regions, and so that's where you're getting that 8% and 9% year over year declines on a constant currency basis. And let's just dive quickly into the sequential quarter over quarter. And so you can see sequentially that there have been improvements quarter over quarter. You just have tough comps because you still had a lot of buying in 2022. So things are looking to improve or are starting to improve a little bit from that tough Q1, but also, you know, part of this is that it just follows the consumer's spending habits, and so, you know, you're just going to have lower spending in Q1 and then a little bit higher in Q2, Q3, etc. You didn't really see that in 2022. You saw it go down. So, you know, I'm hoping that this trend continues, but, you know, it's a wait and see. Let's see how this environment plays out. Now, in the personal system space, you can see that year over year revenue is down due to promotional pricing and currency headwinds. And of course, they are telling you that sequentially the operating profit dollar improvement was driven by higher volumes and disciplined cost management and structural cost reductions. And so, you know, they did tell you, and they did highlight that they were working towards reducing costs in the business. And so you can see this playing out. And so, you know, despite the promotional pricing, operating profit percentage is actually increasing on a sequential basis, which I believe is a good news story that might be getting lost in the fact that revenues are going down. Now, moving into printing, you can see that the revenue decline year over year is driven by lower hardware volumes, but here's the one that scares me a little bit: competitive pricing. And so, you know, I want to understand more about what's happening in the competitive pricing space or happening as a result of it, but they are telling you that the operating profit rate is down year over year due to competitive pricing, and that's the first reason. They also mentioned currency. And so, you know, this has been offset slightly by structural cost reductions and the mix, but, you know, this is something that I really want to pay attention to. This is 30% of the business, and if the profit margin continues to decline materially, I would say that this is in a bit of a challenging place, but it doesn't look like we're there yet. You know, it's still kind of holding between 15 and 20%. Where I'd probably get a little bit more nervous is if it dips below that 15% range, where we are far away from. And so we'll see how this plays out. But overall, it is a steady as she goes business. And, I was very conservative and I was forecasting $2.50 for fiscal year 2023. And so this is really good news for me, where I have actually taken up my expectation to closer to that $3 per share level. Now we're going to dive into the valuation to see at least what I think it's worth, in my opinion. But before we do that, just know that you can get access to the model on HP and all the other models at this lower tier. And of course, if you want to join us for a monthly call every month, I believe it's the best value on YouTube. You also get access to special live courses and a comp schedule, which is what I used to determine which banks, regional banks, that I wanted to invest in. I'm going to add insurance companies into this as well, maybe throw in some retailers. Just having a schedule where you can compare different companies in the same industry at a more granular basis. And so we'll continue to build this out. And so, there's approximately 200 of us that are as part of the team right now, and I really encourage you to join. And so just diving into the HP model, you can see that I'm forecasting revenue to come down 7.5%. That might be too much. So you guys let me know if I'm off the rocker there. But of course, you can see that, SG&A I've brought down a little bit, so that I can get the EPS up to that $3 per share level. I'm leaving the income tax rate at 21.5%. They might have provided guidance on this. I might have missed it. And so I'm just leaving it there for now. And so, overall, once again, steady as she goes. I am bringing the SG&A down over time as they continue to roll out with their cost savings initiatives. So, the question is, does this company go from being a $3 per share company to being a $4 per share company? I think so. But I want to know what you guys think. But then what does this mean in terms of the valuation? Well, overall, I don't think the company's cheap. I also don't think it's expensive. I think, I'm valuing it around $46 per share, and it's currently trading at $29 per share. But of course, that $46 per share is getting penalized by the debt that they have on the balance sheet. So you bring that down to around $39 per share. So it's trading at around 76% of its what I think is its intrinsic value. But just note that the equity yield, it's currently trading at 9.9 times forward earnings. And so it's trading under 10 times earnings. So that tells you something, right? And that represents a 10.1% equity yield. Now, I do want to point out that you're not getting all that equity yield because some of it is being used to pay down the debt. So just FYI, that's the challenge with these companies that have a lot of debt, that, you have to deal with that situation before you can start paying this out to your investors. But overall, it remains a quote unquote dividend stock in an environment where they can really make accretive share repurchases. And so you can see back from 2012 all the way through 2022, you can see that they have been buying back shares. But the one thing I do want to point out is look at how they took out debt in the last 3 years. So, do you really want a company taking on more debt while simultaneously buying back shares? I just think that you're destroying the balance sheet, and you're eventually going to have to stop buying back shares and use that excess capital to pay down the debt, especially as the debt grows. And that's exactly what you're seeing here. Notice that in 2023, they've slowed on buying back shares in favor of paying down the long-term debt, which is a strategy that I agree with. So you can see that the long-term debt has come down while the cash has simultaneously come down. And you can see it better on the cash flow statement itself. So you can see that the repurchase of common stock has been pretty much immaterial in the year. And of course, the payment of debt is $1.7 billion, which pretty much reflects all of the operating cash that they've generated in the year. So you can see that the company is really focusing on bringing that debt down. And why would they be focusing on that? Well, of course, it's because we're in an environment right now where higher interest rates are going to really challenge your bottom line, especially if you have a lot of debt on the balance sheet. So this is something that they really have to focus on. Now, I want to know from you guys, do you think that this is particularly a value opportunity, or wait and see if this can dive even further? I'm no longer in the HP position that I was in earlier this year, and so I'm interested to see what this looks like going forward. And so I want you guys to let me know in the comments below. I respond to everyone. Now, also, I just put out a video on Dollar General, who's also focusing on that debt issue that they're currently dealing with, and you can actually get access to that video right here.